What's up guys, it's Arnold here. Welcome to 2021 and we're going to start it off with a brand new video. Now, in one of my last videos, I talked about the 50-30-20 budgeting framework, where 50% of your income is spent on your needs, 30% is spent on your wants, and 20% is spent on your savings. Now, you might ask yourself, what do I save that 20% in? Should I put it in my checking account? Should I put it in my savings account? Should I buy some stocks and bonds, or should I even buy some Tesla or Bitcoin? These are different types of investment vehicles that you can use to grow your wealth. Now, a key differentiator in quote-unquote rich people is that they use their existing capital, essentially the money they have lying in their bank account, to generate wealth for them. Now, the question for you is perhaps, which of these asset classes should I buy? Which of these investment vehicles should I select, and how should I go about selecting them? Now, today we're going to walk through various types of asset classes. These range from stocks and bonds to fixed income to cryptocurrency, in rising amounts of risk and reward. Generally speaking, risk is proportional to reward. The higher the risk, the higher the potential reward may be. So without further ado, let's get started. Okay, so the first type of asset class. This is generally the least risky, but also the least rewarding. In fact, it's the opposite of rewarding. Over time, it'll actually decrease your wealth. What I'm talking about is cash or cash equivalents. This is money such as money in your checking account or even money hidden under your mattress. These lose value over time because of inflation. Generally, the Federal Reserve has decided that inflation should rise by about 2 to 3% every year. That means the average price of goods and services would rise about 2 to 3% every year. So a bag of potatoes that you buy for $100 today, yeah, that's a lot of potatoes, is gonna cost $102 next year, generally speaking. Therefore, if you leave your cash in a checking account or just on hand, it will generally lose value by 2 to 3% every year because everything else is increased by 2 to 3%. So this is the least rewarding type of asset class. But the caveat here is that you should always save about 6 to 8 months of savings as an emergency fund in case you get into an accident, you need some medical expenses, or you potentially lose your job. The good thing about cash or cash equivalents is that it's very liquid, which means that it can be turned into actual cash that you can spend very quickly because essentially it is cash. The benefit here is that if you need to spend it, you can quickly just take it out of your checking account and spend it. But again, this is not very rewarding, with the caveat that you should save at least 6 to 8 months of savings as an emergency fund. Now, the next asset class is a little bit more rewarding and a little bit more risky, but not by much. It's essentially a very safe investment. So what I'm talking about are bonds or fixed income investments. Bonds are essentially money that you lend to a corporation or a government in return for an interest rate that they'll pay back to you by the end of that term. For example, you can buy these 10-year bonds where by the end of that 10 years, the government will pay you back in about 1 to 3% of interest, as an example. So that means that if you put $1,000 in these bonds, by the end of those 10 years, it might be worth $120 or $130. Another type of fixed income investments are GICs or CDs. GICs being guaranteed investment certificates, which exist in Canada, and CDs, which are certificates of deposit, which exist in the US. Similar to bonds, this is money you lend to a bank where by the end of that term, they'll pay you back in interest. So that's bonds and fixed income investments where the reward is not very high, but the risk is also extremely low. So the next asset class we're going to talk about are stocks. Now, stocks is a huge category of investments because there are different types of stocks, from dividend stocks to growth stocks to value stocks. So we're going to break these down by a couple of categories. The first one we're going to talk about are dividend stocks. These are stocks in companies such as banks or insurance companies where the value of the stock is relatively non-volatile. But the benefit here is that they pay a relatively high dividend. That means that every quarter or every period that the company decides, they can pay you a percentage of the value in stock back to you as the fixed income. So for example, if the stock is worth $100, every quarter they may pay you a 5% dividend, which means that every quarter, in addition to the value of the stock that you own, you'll be paid $5. AT&T, a telecommunications company, is famous for having an extremely high dividend. They have a 6 or 7% dividend yield, which is extremely high for a stock. For stocks, this is considered relatively safe. The value of the stock, generally speaking, won't swing by a crazy amount, and unless there's a major catalyst, which means that something happened to the stock or the market or some external force, the value of the stock will go up and down very minimally on a day-to-day basis. So the next category of stocks we're going to talk about are growth stocks. These are companies where they might not be profitable yet, but their revenues are growing by such a crazy amount and their future potential is so high that analysts and the market values it in an extremely high amount. So for example, this is companies like Tesla or Square, where their future revenues and their future profitability is so massive that analysts in the market have priced it relatively high on a price to earnings basis or price to sales basis. That means that as a ratio of the stock price to its earnings or to its revenues, it is relatively high. These are generally considered a lot more risky because the stock may be extremely volatile. One bad earnings call where the company might report a loss or something that the market did not expect, the value of the stock may drop by 10, 20, 30%. However, the potential reward here is a lot higher. They may run up by 100% in a matter of a few months or a year. So these are the two types of stocks that we'll talk about. There are probably more, but generally speaking, if you want something that is less risky, you'll go with value stocks. If you want something that's more risky but more rewarding, you'd go with a growth stock. So the next category of asset classes we'll talk about are financial derivatives. These are investment vehicles where the value of the investment is not fundamentally tied to the value itself. It is tied to the value of something else. These are considered extremely high risk, but the reward is also extremely potentially high. Of course, you might lose all your money, but you also might double or triple your money in a very small span of time. So an example of which are futures and options. These are financial instruments that are derivatives of the value of an underlying asset, such as a stock. Options and futures gives you the right or the obligation to buy or sell a stock if the stock hits a certain price. Options are optional and futures is mandatory, so you have to buy or sell depending on what the underlying value of the asset is. I'm not going to go too much into it, do your own research if you're interested, but these are extremely high risk and I generally don't dabble in them. So the last asset class we're going to talk about is cryptocurrency. These are examples such as Bitcoin or Ether or Dogecoin or anything in between. Now, this is gaining more and more traction these days, and that is because some investors are treating Bitcoin especially as a stored value asset, something that might replace gold in a certain amount of time. That being said, it is also extremely volatile at this point. The price may swing wildly from day to day. It might go up by 10% and go down by 10% in a matter of a few hours. Again, this is extremely high risk, so do your own research if you want to invest in it, and there are a ton of videos on YouTube talking about Bitcoin and other cryptocurrencies. So those are the asset classes you can choose from: cash and cash equivalents, bonds and fixed income, stocks, and maybe even cryptocurrency and financial derivatives. Now the question is, how do you choose which of these asset classes to buy? Well, what it comes down to, in my opinion, is your risk appetite. And this is based largely on your age, financial situation, and need for liquidity. Firstly, age. If you're young and you've got time in the market, you can generally choose something that is a little bit more risky because you've got the time to ride out the highs and lows of the market. So if you're young, if you just got out of college, I'd recommend buying something that's a little bit more risky, potentially stocks or growth stock, so you can really increase your wealth over the certain amount of time that you're in the market. If you're older or if you don't want to see the price swings, then I might recommend going into something a little bit less risky. Something such as dividend stocks, where you can get a fixed income every certain amount of time. The next determinant of your risk appetite is your financial situation. If you've got a lot of debts such as student loans or medical bills, then potentially I'd choose something that is less risky. I definitely save up in cash and cash equivalents so that you can pay down those debts. And this applies to everyone, but you should always start an emergency fund where you have 6 to 8 months of spending tucked away in your savings account. And the very last determinant of risk is your need for liquidity. If you in the future think that you'll be buying a house or saving up for a wedding, then you want to choose something that is less risky such that you can turn it into cash in a short amount of time. If you put it all into Tesla stock and it suddenly goes down by 20%, you can't take it out because, well, you'll be losing your money. So if you're saving for a house and you want to have a little bit of wealth growing, then I put it in something a little bit safer such that you can take it out and turn it into cash and spend it on your house whenever you need to. So in terms of my thought process and choosing a risk appetite, I'm generally a lot more accepting of risk than others. I prefer to invest in something a little bit more risky but a lot more rewarding potentially. So most of my portfolio is put into growth stocks. So these are high growing companies that are increasing in revenue by a crazy amount every quarter, but they might not be extremely profitable at this time. So that's it, everybody. These are the different type of assets that you can choose and buy depending on your risk profile. Hope to help you out, and if you like this video, please like, share, and subscribe, and I'll see you in the next video.